November 8th, 2022, 7:42 a.m. Eastern Time. A 23-year-old software engineer in Austin named Marcus Chen refreshes his FTX account for the 14th time in 3 minutes. His withdrawal request, $47,000, his entire life savings, shows the same status it's shown since yesterday. Processing. At 8:06 a.m., the button disappears. At 8:19 a.m., the entire withdrawal page goes blank. By noon, FTX has frozen every account. 2 million customers across 130 countries wake up to discover their money has simply stopped existing in any form they can access. Here's what makes this impossible. 6 days earlier, Sequoia Capital had a case study on their website calling Sam Bankman-Fried a future trillionaire. The Ontario Teachers' Pension Plan, the people managing retirement funds for 340,000 Canadian educators, had $95 million invested at a $32 billion valuation. SoftBank, NEA, Temasek, the smartest institutional money in venture capital, had all written checks. This isn't a story about a crypto exchange going bankrupt. It's a story about how the most sophisticated investors in the world, with full access to financial statements and management, missed every single red flag while retail depositors saw their life savings vanish in 7 days. Rewind to September 2021. Sam Bankman-Fried, 29 years old, cargo shorts and wild hair, stands on stage explaining how cryptocurrency exchanges should be regulated. He's testifying before Congress, not as a defendant, as an expert witness. He's advocating for clearer rules, more oversight, investor protection. The politicians nod along. He seems like the reasonable one. Behind him sits the crown jewel of his empire, FTX, a cryptocurrency exchange he founded in 2019 that by 2022 had become the second largest in the world by volume. The pitch was simple: crypto trading for grown-ups. While competitors faced hacks and regulatory scandals, FTX positioned itself as the institutional-grade platform. Clean interface, celebrity endorsements, Tom Brady and Gisele Bündchen as equity investors and brand ambassadors, a $135 million naming rights deal for the Miami Heat Arena. The venture capital world bought it completely. In January 2022, FTX closed a $400 million Series C led by Sequoia Capital at a $32 billion valuation. The investor list read like a who's who of elite Silicon Valley money: SoftBank Vision Fund, Lightspeed Venture Partners, Insight Partners, NEA, Temasek, Paradigm, Coinbase Ventures, Thoma Bravo. 3 months later, they came back for more. Another $420 million, again led by Sequoia, joined by the Ontario Teachers' Pension Plan. Sequoia published a glowing profile on their website. They described meeting Sam Bankman-Fried over Zoom, watching him play League of Legends during a pitch meeting while simultaneously answering their questions, and deciding this was the future of finance. The headline literally called him the next great investor of his generation. Their partner wrote, "I knew I was talking to someone who was going to be a future trillionaire." Read that number again, not billionaire. Trillionaire. The due diligence process for a Series C of this size typically involves months of financial review, customer interviews, technical audits, legal examination. Sequoia had the balance sheets. SoftBank had full access to management. Ontario Teachers had fiduciary responsibility to verify every claim. And they all said yes, so did retail investors. By November 2022, FTX held customer deposits worth approximately $8 billion. These weren't sophisticated traders. These were teachers, software engineers, nurses, people who'd been told FTX was the safe choice in crypto. Many had moved their funds specifically because other exchanges seemed risky. Here's what the consensus believed: FTX was solvent, regulated, backed by the smartest money in tech, and run by a founder who literally testified before Congress about protecting customers. On November 2nd, 2022, a financial journalist named Ian Allison published 847 words that would reveal every syllable of that consensus was wrong. The article appeared on CoinDesk at 9:00 a.m. Eastern. The headline: "Divisions in Sam Bankman-Fried's crypto empire blur on his trading titan Alameda's balance sheet." Here's what Ian Allison had obtained. Alameda Research's balance sheet from June 30th, 2022. Alameda was Sam Bankman-Fried's trading firm, separate from FTX, but owned by the same person, a hedge fund that supposedly made sophisticated bets in crypto markets. The balance sheet showed $14.6 billion in assets. That sounds impressive. Here's what made it impossible. $366 billion of those assets, 25% of the entire portfolio, was FTT tokens. FTT was FTX's own exchange token, not Bitcoin, not Ethereum, not anything traded on external markets with independent price discovery. A token that FTX itself had created that derived 100% of its value from confidence in FTX, held as the primary asset backing a trading firm that was supposedly independent from the exchange. Picture what this means in traditional finance terms. Imagine Goldman Sachs owned a hedge fund, and that hedge fund's largest asset was Goldman Sachs stock that Goldman Sachs printed for itself and hasn't sold to outside investors yet. That's not an investment. That's a circular reference. The value of the token depended on FTX remaining solvent, and FTX's solvency depended on Alameda's balance sheet, and Alameda's balance sheet depended on the token maintaining its value. And this is the part nobody talks about. This information was public. CoinDesk didn't hack into a server. Alameda Research had filed this balance sheet. It was available to anyone who went looking. Every institutional investor who'd written a check to FTX in 2022 could have found this with a basic Google search and a phone call. But here's where it gets strange. The same day the article published, Caroline Ellison, CEO of Alameda Research, responded on Twitter. She wrote, "That specific balance sheet is for a subset of our corporate entities. We have over $10 billion in assets that aren't reflected there." Stop and read that again. She's not denying the $366 billion in FTT. She's saying, don't worry, we have way more assets you're not seeing. As if the problem was that people thought Alameda was too small, not that it was built on a house of cards. Prosecutors would later reveal Alameda did not have these assets, but SBF did, because he'd been using FTX customer deposits to fund Alameda's trading operation. 4 days later, November 6th, the second shoe drops. Changpeng CZ Zhao, CEO of Binance, FTX's main competitor, tweets at 1:39 p.m. As part of Binance's exit from FTX equity last year, Binance received roughly $2.1 billion USD equivalent in cash, BUSD and FTT. Due to recent revelations that have came to light, we have decided to liquidate any remaining FTT on our books. Translation: the largest holder of FTT tokens outside of FTX and Alameda just announced they're selling. And if they sell, the price crashes. And if the price crashes, Alameda's balance sheet collapses. And if Alameda collapses, the bank run starts immediately. By November 8th, customers have requested $5 billion in withdrawals. FTX processes $1 billion and then stops. At 8 a.m. Eastern, withdrawal functionality goes dark. By 4:00 p.m., Sam Bankman-Fried tweets that FTX has a liquidity crunch and is seeking rescue financing. Binance announces they'll acquire FTX. It's November 9th. The deal lasts 24 hours. On November 10th, Binance walks away, releasing a statement. In the beginning, our hope was to be able to support FTX's customers to provide liquidity, but the issues are beyond our control or ability to help. What did they see in due diligence? We know from bankruptcy filings filed later, FTX had taken $8 billion in customer deposits and sent it to Alameda Research. Not lent it, not invested it, sent it. Alameda had used it to make venture capital investments, buy real estate in the Bahamas, fund Sam Bankman-Fried's political donations, and cover losses from bad trades. The money wasn't in some illiquid investment that needed time to unwind. It was gone. On November 11th, 2022, 9 days after the CoinDesk article, FTX files for bankruptcy. Sam Bankman-Fried resigns. John J. Ray III takes over as CEO, a restructuring specialist known for unwinding Enron. His first filing with the bankruptcy court contains this sentence: "Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as occurred here." John Ray had unwound Enron, and he said FTX was worse. Here's what makes this analytically interesting. Every single warning sign was visible before November 2nd. Retail investors on Reddit had been posting about delayed withdrawals since August. The conflict of interest between FTX and Alameda was public. Sam Bankman-Fried openly owned both companies. His political donation records were public filings showing he'd donated $40 million to political candidates in the 2022 cycle alone, raising the obvious question, where was a 30-year-old getting $40 million in cash? But this is where it stops being a coincidence. Because while retail depositors were posting anyone else having trouble withdrawing, on forums, institutional investors with full access to financial statements were leading a Series C at a $32 billion valuation. The trap has a name, authority bias, compounded by social proof. Here's how it works. Sequoia invests. That signal tells every other VC this has been vetted. SoftBank invests. That tells the next investor, if SoftBank's diligence team cleared it, I don't need to dig as deep. Ontario Teachers invests. That tells retail investors, pension funds are conservative. If they're in, this must be safe. Each investor outsources verification to the previous investor's diligence. Nobody actually checks the foundation because everyone assumes someone else already has. Think of it like a bridge. The first engineer says, I checked. The concrete is solid. The second engineer says, well, the first engineer checked. The third engineer says, 2 engineers already signed off. By the time 1,000 cars are driving across daily, nobody's actually testing the concrete anymore. They're just watching other cars make it across and assuming that's proof. Now add a second element, narrative capture. Sam Bankman-Fried wasn't just running a crypto exchange. He was testifying before Congress. He was calling for regulation. He was professing adherence to effective altruism, a philosophical movement about doing maximum good. He'd built a character, the responsible crypto guy, the one who wanted oversight, the adult in the room. When you meet someone who talks about regulation and ethics, your brain files them under trustworthy. You stop looking for fraud because the narrative says this person is the opposite of a fraudster. This same pattern appears twice in financial history with eerie precision. Bernie Madoff ran the largest Ponzi scheme in history, $65 billion in claimed assets that didn't exist. His investors included sophisticated hedge funds, international banks, and charities. Why didn't they verify? Because Madoff had been chairman of NASDAQ. His brother was on the board of FINRA, the securities industry regulator. The man was literally part of Wall Street's regulatory infrastructure. Authority bias made verification feel unnecessary. Elizabeth Holmes at Theranos raised $700 million from investors, including Rupert Murdoch, the Walton family, Betsy DeVos, and Tim Draper. Her board included Henry Kissinger, George Shultz, and 2 former cabinet secretaries. The blood testing technology didn't work, but nobody checked because the board credentials created an assumption of legitimacy. In each case, the more prestigious the backers, the less additional diligence anyone performed. The social proof became the diligence. And in each case, retail customers and small investors paid the price when the narrative collapsed and reality came due. This pattern is playing out right now in at least 3 places worth watching. First, artificial intelligence startups with billion-dollar valuations based on proprietary models that outside investors can't audit. OpenAI, Anthropic, Character.ai. Each has raised billions on the promise of breakthrough technology, with NDAs preventing investors from examining the actual training data, model architecture, or cost structure. The diligence process relies entirely on trust in the founders and the presence of other prestigious investors. The number to watch, revenue per employee. If it's dramatically below comparable tech companies, the business model isn't generating real economic value regardless of the technology claims. Second, private credit funds. As banks retreated from risky lending after 2008, private equity firms created credit funds that now hold $1.6 trillion in loans. These loans don't trade on public markets. There's no daily price discovery. Valuations are marked to model, meaning the fund itself determines what the loans are worth. Pension funds and endowments have piled in because the stated returns look stable. The threshold to watch: if interest rates stay above 4% and default rates in private credit remain mysteriously below public credit markets. Someone is lying about valuations. When the mark's correct, it will happen in 72 hours, just like FTX. Third, emerging market stablecoins. Tether, USDC, and others claim $1 backing for every token issued. The reserves are supposedly held in US Treasuries and cash equivalents. But attestations aren't audits. Circle and Tether have both resisted full third-party audits. If you're holding a stablecoin, the specific disclosure to watch: whether the reserves are held in US banks subject to FDIC oversight, or offshore in institutions with no regulatory requirement to hold the reserves at all. In March 2023, Sam Bankman-Fried was arrested in the Bahamas and extradited to the United States. In November 2023, a jury convicted him on 7 counts of fraud and conspiracy. On March 28, 2024, a judge sentenced him to 25 years in federal prison. Prosecutors successfully argued he had run one of the biggest financial frauds in American history. Marcus Chen, the software engineer from the opening who lost $47,000 when withdrawals froze, received approximately $4,100 in the bankruptcy proceedings. He lost 91% of his life savings. Sequoia Capital wrote their entire investment down to zero. SoftBank did the same. Ontario teachers lost $95 million. Here's the single thing worth remembering. The retail depositor checking Reddit threads about withdrawal delays had better information than the venture capital firm with board seats and quarterly financial reviews. Not because he was smarter, because he had something to lose. The market isn't a machine for making money. It's a machine for transferring money from people who trust credentials to people who verify claims. And the bigger the credentials, the less verification happens, right up until the moment everyone discovers the concrete was never tested at all.